Welcome to the deep dive. In a world just swimming in data, and, well, with AI changing everything, Palantir Technologies has really become a central name.
Absolutely. And that stock performance in 2024, carrying right into 2025, it's certainly got people talking, asking what's really underneath it all.
Exactly. So in this deep dive, specifically for you, we're aiming to look past those headlines about Palantir.
Yeah, we've pulled together quite a stack of recent research. We're going to try and dissect, the core business, who's leading it, what the financials are telling us.
The market mood, the risks, the opportunities, all of it.
Right. Based on all this material we've gathered.
Our mission today is pretty straightforward, really.
Yeah.
We want to give Palantir a thorough look over using everything we've found, cut through the noise,
And give you a clear, deep understanding of what's going on with this, frankly, fascinating company.
We'll definitely talk about the exciting potential, but we also need to hit those critical questions any smart observer should be asking.
Definitely. And just a reminder, if you want to dig deeper yourself, all the sources we're using today, links are right there in the description below.
Okay, let's get into it then. Chapter 1. Understanding the business itself. Fundamentally, what does Palantir do?
Right. So at its heart, Palantir is a software company. They specialize in big data analytics platforms,
Okay.
but specifically for really complex, often high-stakes environments, so their clients. They range from government, think defense, intelligence, to commercial businesses across loads of different industries.
And how do they actually make money? What are the main income streams?
It boils down to two main things. First, software subscriptions or licenses. So clients pay usually recurring fees to use their main platforms, Gotham, Foundry, and the newer one, AIP, the AI platform.
Right.
And these can be run in the cloud or, on the client's own systems. These deals, especially with governments, often mean long-term contracts, which gives them a bit of revenue stability.
Okay, so subscriptions is one. What's the second?
That's their professional services. This covers things like consulting, helping clients actually implement and tailor the platforms, training their staff, and providing ongoing support.
Ah, so hands-on help.
Exactly. They often embed their own engineers with clients to get things just right. It builds strong relationships, for sure, but it also means it's a more, let's say, resource-heavy model than just selling software licenses. And what's really interesting is how that revenue mix is changing. Historically, government was the big piece, like 55% in fiscal 23.
Okay.
But in fiscal 24, while their total revenue grew nicely, up 29% to about $2.87 billion, their U.S. commercial business jumped 54%.
Wow, 54%.
Yeah, huge growth there. Way faster than the U.S. government side, which still grew a respectable 30%. So this push into commercial, it's a really big deal for their strategy.
That sounds like a key shift. It means diversifying away from maybe uncertain government budgets.
Precisely. Tapping into potentially a much larger, faster-growing market. But of course, that also means facing different competitors, needing a different sales approach compared to those established government ties.
Makes sense. Let's talk about those core products you mentioned, Gotham, Foundry, AIP. What's the story with each?
Okay, so Gotham, that's kind of the original, launched back in 2008. Its main playground has always been the intelligence and defense world.
Right.
Think about pulling together huge, messy data sets, geospatial info, all that stuff for counterterrorism or military planning. It's super specialized. And critically, it has what's called IL-5 authorization.
IL-5?
Yeah, it's a high-level security clearance from the U.S. Department of Defense. Lets it handle classified data. That's a big barrier for anyone else trying to compete in that space.
Got it. And Foundry, how's that different?
Foundry is aimed more at commercial companies and civilian government agencies. It's designed to be like a central operating system for data. A place to bring all your separate data sources together, analyze them, and then, crucially, turn those insights into actions across the business, optimizing supply chains, manufacturing, you name it. The goal is to make data useful for more people in the organization, not just the tech wizards.
Then there was Apollo. Sounds like it works in the background.
Exactly right. Apollo started as an internal Palantir tool. They built it to manage deploying and updating Gotham and Foundry across all sorts of different environments, cloud, on-premise, even out at the edge. It handles updates, compliance, all that critical stuff. What's interesting is they started selling Apollo commercially in 2022 to other software companies facing similar deployment headaches.
And AIP, the artificial intelligence platform, seems like that's the one getting all the attention lately.
It really is, and probably for good reason. AIP is their newest big thing. It basically weaves generative AI, like large language models, right into Foundry and Gotham. The big idea is to let organizations use these powerful AI tools on their own private data, but within a secure, controlled system. It's about making AI actually useful for day-to-day operations.
So bridging the gap between the AI hype and real work.
That's the aim. They have tools like AIP Assist. Think of it as an AI co-pilot for analysis and AIP logic for building more complex AI agents. They're definitely positioning AIP as a major growth engine, especially on the commercial side.
You also mentioned something called the ontology. Sounds a bit abstract.
It does sound theoretical, yeah. But think of it like this. It's a dynamic digital map or digital twin of how an organization actually works.
A map.
Yeah, it models everything, the things in the business, like customers or products, how they relate to each other, the processes, the events. This layer of understanding, this context, is absolutely vital.
Why vital?
Because it's what lets the AI understand the meaning behind the raw data, not just process numbers. It allows the AI to be context-aware and actually integrate usefully into workflows. It's like the master blueprint that makes sense of it all for the AI.
Okay, that helps clarify it. So putting all this together, where does Palantir actually stand in the market? How big are they? What's their position?
Well, they've definitely carved out a strong position, especially in AI and big data for sectors needing high security and handling really complex data. They get recognized as leaders by firms like IDC and Dresner.
Right.
They're in over 50 industries now. Their market cap, as of early May 2025, is huge, around $293 billion. And customer growth looks solid too, hitting 711 customers by end of Q4 2024, up 43% year on year.
Driven by that U.S. commercial growth you mentioned.
Largely, yes. But here's the kicker. You've got this massive market cap, $293 billion compared to revenue of, $2.87 billion in FY24, and GAAP net income of $462 million.
That's quite a gap.
It is. It tells you the market has priced in absolutely enormous expectations for future growth and profit. That's a major valuation risk right there. The current price needs almost flawless execution to be justified.
So the market is betting heavily on that future potential, maybe driven by AIP.
Seems very likely. They're betting on continued high growth, margin expansion, sustained competitive advantages. Any stumble, and that premium valuation could correct sharply.
Okay, let's boil it down. What's the core value proposition? Why do companies choose Palantir?
Fundamentally, Palantir helps organizations make better decisions by turning their messy data into something they can actually use operationally.
Making data useful.
Exactly. They focus on the really hard problems, integrating data from everywhere, providing tools for human analysis boosted by machine learning. And now with AIP, they let companies securely use AI on their sensitive data.
Which is key for their government and regulated industry clients.
Absolutely. Security and privacy are built in. And they push the idea of getting results quickly, like with their AIP boot camps. Their sweet spot is really those complex, high-stakes, secure environments.
Okay, so quick recap of Chapter 1. Palantir's a software firm, big data analytics for tough, secure jobs, governed commercial clients, makes money via subscriptions and services for Gotham, Foundry, Apollo, and the new AIP. Big U.S. commercial growth push, but wow, that market cap versus current earnings suggests huge future expectations are baked in. All right, let's move to Chapter 2, the management team.
Right, evaluating the leadership. And what's notable here is the continuity. The co-founders are still very much in charge since way back in 2003.
Still the same core group.
Yeah, Alex Karp is CEO, Peter Thiel is chairman, Stephen Cohen is president. That's a long run. They've overseen product development, the move into commercial, and importantly, getting the company to GAAP profitability in the last couple of years.
Alex Karp's leadership style often gets mentioned. He seems unique. And Peter Thiel's influence.
Karp definitely has a more philosophical long-term view. His communications can be, well, quite different. Thiel's obviously a huge figure in tech, influential, known for his investments and his libertarian conservative views. That definitely shapes Palantir's image and maybe strategy too.
And Stephen Cohen.
He's been there from the start, seen as really key on the product development side.
How have they handled tricky situations, controversies, crises?
They've faced scrutiny, no doubt, like over government contracts, say, with ICE. Their response tends to be, we provide neutral tools for legal government functions with ethical safeguards built in. During COVID, they pivoted to help health agencies manage data. Going public via a direct listing was also an unconventional move they managed. And lately, they're really emphasizing that commercial growth and AIP, perhaps partly to counter concerns about slowing government growth.
What about communication? Are they transparent?
It's evolved. They used to be quite secretive given their sensitive government work. Now, as a public company, they do the required disclosures, earnings calls, filings, etc.
But CURP's letters can be a bit different.
Yeah, they offer strategic insights but can be philosophical, sometimes intentionally provocative. Some observers call their style brash and want more clarity, maybe on the details of the business model shift. Financially, though, they do provide those non-GAAP reconciliations.
Let's talk ethics. Their government work, especially, often sparks debate. What's the reputation, and how does management handle it?
It's a really important point. Working in defense, intelligence, law enforcement areas like predictive policing or ICE support naturally attracts criticism from privacy groups and others worried about government power or misuse of tech.
Understandable concerns.
Palantir's consistent answer emphasizes their ethical principles, building privacy features in from the start, the need for human oversight in big decisions, and aligning their work with Western democratic values. They've even said they've turned down work they felt was ethically wrong.
But the scrutiny probably won't go away.
Unlikely, given the power of the tech and who uses it. Plus, the known political views of Karp and Thiel inevitably pull the company into wider political debates.
Okay, let's switch gears to control. We hear the founders have a lot of voting power. How does that work, and what does it mean for governance?
Yeah, this is key. They have a multi-class share structure, Class A, B, and F. The Class F shares, held just by the founders in a trust, are designed so they collectively keep about 49.99999% of the voting power, as long as they meet certain ownership levels.
Almost 50%, so they effectively control the company.
Pretty much. They control shareholder votes, board elections, major decisions. Now, this can mean stability, focus on long-term strategy, but it drastically limits the influence of public Class A shareholders. Standard governance concerns about accountability definitely arise. Founder interests or ideologies could potentially override maximizing value for all shareholders.
And we've also seen reports of a lot of insider selling. What's the take on that?
Yes, there's been a steady stream of significant stock sales by top execs, Karp, Cohen, Thiel included, mostly through preset 10b5-1 plans.
Which are legal ways for insiders to sell stock.
Correct. But the sheer volume of sales, especially with the stock valued so highly, definitely raises eyebrows. It could suggest management thinks the stock is fully valued, maybe even overvalued.
Which might seem at odds with their bullish public statements.
Potentially, yes. It's something investors watch closely, that possible gap between public talk and private actions with their own shares. And remember, those ethical issues aren't just PR. They can be real business risks affecting talent recruitment, ESG investors, regulatory heat, even contracts getting canceled.
Given the bullish narrative management consistently puts forth, isn't this level of selling a potential red flag for investor confidence? What could be some counter-arguments to that concern?
That's a fair question. The counter-arguments usually focus on standard diversification executives needing liquidity for personal reasons, taxes, philanthropy. Also, many sales are via those 10b5-1 plans set up before specific news events, arguing it removes timing discretion. And some insiders still hold very large stakes. But the scale and consistency of the selling at Palantir does make it a persistent point of discussion.
Okay, moving to how they use their money capital allocation, what's the strategy there?
The main focus seems to be funding organic growth, especially R&D. They spent over $500 million, $508 million, on R&D in fiscal 24. That's about 18% of revenue.
So investing heavily back into the tech.
Right. Crucial to stay ahead, particularly in AI.
What about buying other companies or giving cash back to shareholders?
Big acquisitions haven't really been their recent focus. They seem to prefer growing from within and strategic partnerships like the one with Anthropic. They did some SPAC investing earlier, but that seems less central now.
Share buybacks, dividends.
They have a $1 billion buyback program authorized, but only used about $64 million in FY24. So pretty modest buybacks relative to their size. No dividends currently, and they say they plan to reinvest earnings back into the business.
Okay, let's talk return on invested capital, ROIC. Does it show they're using that capital effectively?
ROIC is key, how much profit they generate from the capital they've put to work. Historically, Palantir's ROIC was negative because, well, They weren't consistently profitable.
But that's changing now.
It is. Since hitting GAAP profitability, we're seeing positive ROIC trends. Though the exact numbers vary a bit depending on who's calculating reports, range from maybe 9% to over 30% for FY24.
So the crucial comparison is ROIC versus their cost of capital, the WACC.
Exactly. Real value is created when ROIC is consistently higher than WACC. Given Palantir's volatile stock and equity-heavy funding, their WACC is likely pretty substantial.
So the jury's still out on whether they're truly creating economic value yet.
The improving ROIC is positive, definitely. It suggests investments are getting more efficient, but whether it's consistently beating that likely high WACC, that needs more time and data to confirm. It's something to keep a close eye on, especially with that high valuation. Essentially, are they earning more on investments than it costs to get that capital?
Right. Okay, summing up management. Long tenure, achieved profitability, but questions around shareholder alignment due to founder control and insider selling. Capital goes to R&D, ROIC improving, but needs to clear the WACC hurdle consistently. Let's move to Chapter 3, diving into the financial health.
Okay, the numbers, deep dive. Market cap, as we said, around $293 billion. The PE ratio is, well, it's an extreme. GAAP PE for FY24 is something like 654x.
654 times earnings.
Yep. Even the adjusted non-GAAP number is over 300x. These are incredibly high multiples. It just screams that the market expects massive future earnings growth.
But we did see strong revenue growth, right? That's the other side of the coin.
Absolutely. That's the fuel for the optimism. Revenue growth is impressive, 29% in FY24, hitting $2.87 billion. It even accelerated to 36% in Q4 '24. And their guidance suggests they expect around 31% growth for FY25. So the top line is definitely moving fast.
What about profit margins? Are they healthy?
Gross margins are very strong, around 80.3% for FY24. Typical for software, really. GAAP operating margin for the full year was around 10.8%, maybe 11%, a big improvement.
Though Q4 was hit by something.
Yeah, some one-off stock appreciation rights costs impacted the Q4 operating margin. Exclude that, and was nearer 17% for the quarter, maybe 15% for the full year on an adjusted basis. GAAP net margin for FY24 was about 16.1%.
And the adjusted margins are even higher.
Right. Adjusted operating margin, which excludes things like stock-based comp, hit 39% for the year and 45% in Q4 '24. So profitability, especially on an adjusted basis, looks quite robust now.
And the balance sheet. And any worries about debt?
No, quite the opposite. The balance sheet is a real strength. Very little long-term debt. Debt to equity is super low, like 4.8%. They have a ton of cash on hand. Gives them a lot of flexibility.
And they're generating cash, too.
Yes, strong free cash flow. Adjusted FCF for FY24 was $1.25 billion, a healthy 44% margin. GAAP operating cash flow was also strong at $1.15 billion.
We also saw a very high price-to-book ratio.
Yeah, extraordinarily high, around 55 to 58x. Again, it just highlights how much the market is valuing future potential over current tangible assets.
So the picture is strong growth, improving profits, great balance sheet, but these sky-high valuation multiples, that's the tension.
That's the core tension, especially for value-focused investors. There's a real disconnect between the positive fundamental trends and the extreme stock price ratios.
And we should remember the GAAP versus non-GAAP difference.
Definitely. A big driver there is stock-based compensation, $691 million in FY24. Common in tech, yes, but it does dilute existing shareholders over time, something to factor in.
Okay, let's look a bit closer at financial stability. How consistent have earnings been historically?
Well, for a long time, Palantir wasn't consistently profitable on a GAAP basis. FY23 was the big turning point, their first full year in the black under GAAP, and they kept that going through FY24.
So 6 profitable quarters in a row by the end of 2024.
Correct. Which is definitely positive, shows better financial discipline, but it's still a relatively short track record of sustained GAAP earnings. We need to see how it holds up over more time through different economic cycles to really judge long-term consistency.
Dividends seem off the table for now. What about debt management?
As we said, that's a clear plus. Minimal long-term debt compared to a huge cash pile. They're in a strong net cash position. Lots of flexibility there.
And managing working capital, the day-to-day operational cash, seems okay.
It looks pretty efficient. We don't have super detailed ratios in front of us, but strong cash flow generation, high liquidity ratios like current and quick ratios are very high, and positive net working capital figures suggest they're managing it well.
Even with potentially slow payments from big government contracts.
Seems so. Their overall strong financial health indicates working capital is generally under control.
Okay, wrapping up financials. Profitable now, strong balance sheet, low debt. But that profitability track record is still quite new, and those valuation multiples are just exceptionally high. Right, let's move on. Chapter 4. Market sentiment. What's the mood out there towards Palantir?
It's definitely a mixed bag, quite divided, actually. On one side, you have strong recognition they're seen as a leader in hot areas like AI and big data. And you can't ignore that stock performance over the last year or so. It's been stellar.
AIP adding fuel to that fire.
Seems likely, yeah. The launch and talk around AIP adoption has definitely boosted positive sentiment for many investors.
But there's also a lot of skepticism about the price, isn't there? Overvaluation concerns.
Oh, absolutely. Many analysts and observers look at traditional metrics, PE, price to sales, PEG ratio, and say the stock looks significantly overvalued compared to history and peers.
Any technical signs, flashing warnings?
Some technical analysis suggests maybe some caution is warranted. The stock might be hitting resistance levels, maybe some signs of upward momentum weakening a bit.
Interesting point about tariffs, the idea they might be somewhat insulated.
Yeah, there's a perception that, compared to companies dealing in physical goods, Palantir is less directly exposed to potential 2025 U.S. tariffs. That might have actually helped its stock price recently, acting as a relative safe haven within tech, perhaps.
What about the professional analysts? What are their ratings and price targets saying?
The overall consensus on Wall Street leans towards hold right now, and what's really striking is the gap between the current stock price, around $124, and the average analyst price target.
Where do those targets sit?
Various sources put the average or median target somewhere in the $87 to $96 range, so quite a bit lower than where it's trading.
Though there's a wide range of opinions.
Huge range. Some are very bearish, with targets down at $18 or $40. Others are bullish, up around $125, even $141. But a lot of analysts are sitting on hold or even sell ratings, implying downside risk based on fundamentals.
So a real disconnect between cautious analysts' views and the stock's strong momentum.
Exactly. That's a key feature of the current sentiment picture for Palantir.
What kind of news really moves the needle for Palantir's stock?
Several things. Quarterly earnings reports are huge, especially with expectations so high right now.
Contract wins.
Definitely. Big government deals, major commercial partnerships, those usually give the stock a boost. Macro news like tariff talk or interest rate changes can influence sentiment too, even if the direct impact seems limited.
Analyst upgrades or downgrades?
Those can certainly move the price. And of course, any negative news or controversies can push the stock down.
Let's look at trading activity. Short interest, options. What do they tell us?
Short interest, the percentage of shares borrowed and sold short is relatively low to moderate, maybe 2% to 3% of the float.
And days to cover is short.
Yeah, less than 1.5 days usually. Suggests short sellers aren't overwhelmingly negative or worried about a big squeeze, although it is worth noting that short interest is generally higher than its software peers.
What about options trading?
That's where it gets interesting. Consistently high volume, often described as unusual activity, lots of speculation and hedging going on.
What's the sentiment in options? Bullish? Bearish?
It seems pretty mixed. Lots of trading in both calls, bets on price rises and puts, bets on price falls. Implied volatility is high, especially around earnings, meaning the market expects big price swings.
And large trades happening.
Yeah, we often see big sweeps or blocks, which can hint at institutional positioning, though the direction isn't always clear. Overall, the options market signals a lot of uncertainty and an expectation of continued volatility.
So complex market view? Excitement about AI potential clashes with serious valuation concerns? Okay, Chapter 5. Ownership structure. Who holds the reins at Palantir?
It's quite concentrated in some ways. A large chunk is held by institutional investors, nearly 3,000 of them, holding about 1.3 billion shares collectively.
Big names like Vanguard, BlackRock.
Exactly. Vanguard, BlackRock, State Street are usually the biggest holders. Also firms like Geode, Morgan Stanley, the Invesco QQQ ETF. We do see some shifts. Recent filings show some funds buying more, others trimming. But the average allocation to Palantir in these big portfolios tends to be pretty small.
What about insiders? The founders and early team?
They still hold significant stakes. Thiel, Cart, Cohen, other early folks. Historically, a lot of this was in Class B shares, which have more votes, and that super voting Class F stock.
Peter Thiel still a major holder?
He was reported as a very large holder as of late 2024, yes. But, as we talked about, there's that consistent, substantial insider selling happening too.
Via those 10b5-1 plans.
Right. CARP, Cohen, others selling regularly, often converting Class B to Class A or exercising options and selling. Again, legal and common for diversification, but the sheer volume raises those questions about their view on the valuation. We've also seen some members of Congress trading the stock.
Let's revisit those share classes. How does that structure really impact control and governance?
It's central to Palantir's governance. Class A is 1 vote per share, Class B is 10 votes, and Class F, held only by the founders and trust, is designed to keep their collective voting power at just under 50%.
So they effectively have control over shareholder votes.
Yes. Board elections, major deals like mergers, they hold the deciding power. It limits the influence of public Class A shareholders significantly.
Good for long-term focus maybe, but bad for accountability.
That's the trade-off, and why governance advocates often dislike these structures. It can shield management from accountability and potentially let founder interests diverge from other shareholders. The board itself includes founders, VCs, some others with past Palantir ties.
So combining that founder control with the insider selling creates a complex picture for investors assessing alignment.
Definitely. It's a landscape that requires careful consideration when thinking about whose interests are really driving decisions.
Okay, so institutions own a lot, but founders have the voting control via special shares, and there's significant insider selling. Let's move to Chapter 6. Risk assessment using a SWOT analysis.
Right. SWOT helps structure this. Let's start with strength. Clearly, their advanced tech platforms are a major strength. Their strong position in government is another.
Highest switching costs for clients.
Yes, once you're deeply integrated, it's hard to leave. They're improving financials, profitability, margins, cash flow, low debt are strengths now, skilled workforce, and that growing commercial traction.
Okay, what about the weaknesses? Internal vulnerabilities.
The extreme valuation is number one. Huge downside risk if they don't meet expectations. Sales cycles can be long and complex. Implementation isn't trivial either.
The profitability track record is still short.
Relatively, yes. High stock-based compensation dilutes shareholders. That founder control and governance structure is seen as a weakness by many. And historically, some dependence on a few very large government deals.
Where are the biggest opportunities for growth?
The overall market for big data and AI is just enormous, still growing fast. That's a huge tailwind. Expanding AIP adoption is key.
More commercial penetration.
Absolutely. Breaking further into the commercial world, developing new products, expanding internationally, more strategic partnerships, lots of potential growth avenues.
And finally, the threats. External risks.
Intense competition is a big one from established giants and nimble startups. A potential recession hitting IT budgets is a threat.
Regulatory hurdles, ethical risks.
Yes, growing scrutiny around data privacy, AI ethics, government contracting. Those ethical reputational risks tied to their work are ongoing. Geopolitical risks, given their defense work. Tech disruption needing to constantly innovate, and maybe the biggest threat, simply failing to meet those sky-high market expectations baked into the valuation.
We also wanted to specifically hit the potential impact of those 2025 U.S. tariffs. What's the likely story there?
The direct impact should be pretty limited. They sell software and services, not physical goods being tariffed.
So the risk is more indirect.
Exactly. The main worry would be tariffs causing a broader economic slowdown. That could squeeze IT budgets for both government and commercial clients, slowing Palantir's growth.
Customers in tariff-hit industries might cut back.
Plausibly, yes. If their own businesses suffer, they might delay IT projects. There's a tiny theoretical risk of retaliatory measures, but that seems less likely for services.
But could they actually benefit relatively if investors seek safer tech stocks?
Some analysts suggest that. In uncertain trade environments, money might flow to software perceived as less exposed than, say, manufacturers, so maybe relative plus. But overall, the biggest tariff risk is just a general economic slowdown hitting spending and sentiment.
Okay, so a complex SWOT. Strengths in tech and gov, opportunities in AI and commercial, but weaknesses in valuation and governance, and threats from competition and macro factors. Tariffs seem like a secondary, indirect risk. That brings us to our final chapter, Chapter 7, Conclusion.
Yeah, wrapping it up. Palantir is definitely a complex case. You've got clear strength, the tech, the government foothold, that commercial growth starting to fire.
But
significant concerns, too. That extreme valuation is impossible to ignore. The governance issues around founder control, the steady insider selling, the still relatively short history of GAAP profits.
and that valuation seems to be the main point of contention, right?
Yeah.
Analyst consensus points to overvaluation.
Precisely. Most conventional analysis suggests the stock price is way ahead of fundamentals. The governance and insider selling just add layers of questions about alignment between leadership and public shareholders.
So fundamentals are improving, tech is in demand, but the price looks stretched.
That's the nutshell, yeah. The current share price seems detached from intrinsic value based on the numbers we have today. It suggests a significant pullback might be needed for better alignment. And those tariff risks, probably secondary to these core valuation and governance concerns.
Okay. And now, for our end hook. Given Palantir's mission to partner with some of the world's most critical institutions and its increasing integration of AI into their core operations, what are the potential long-term societal implications of such concentrated technological power, and what frameworks of accountability should be in place to ensure its ethical deployment?
That's a big question, and one we'll likely keep exploring in future deep dives.
Definitely something to think about. If you found this analysis useful and want more like it, please do subscribe to the Stock Analytics AI YouTube channel.
We'll be doing more deep dives into companies and market trends there.
And just the necessary disclaimer. This analysis reflects research available as of May 3rd, 2025. We may have used AI tools to help summarize and organize information. And importantly, this is not financial advice.
Always do your own research. And next time on the deep dive, we'll be unpacking the rapidly evolving world of quantum computing and looking at the key players emerging in that potentially game-changing field.